Hi, welcome to our audio version of our technical bulletin, The Pros and Cons of Insurance-Based Deductions on Benefit Payments. My name is Tim Miller and I'm the Education Manager at SuperGuardian. In this bulletin, what we're going to discuss is we're looking at the insurance-based deductions that are available subject to certain benefit payments. And the purpose of this is an extension of what we've considered in other previous bulletins about conditions of release and accessing super. And so we're taking it that one step further to identify other opportunities within the fund when you have insurance-based benefits to pay out. So what we're going to look at is what those deductions are and how they are available. We'll consider disability benefits versus permanent incapacity and just look at the slight differences between those two definitions. We'll then touch on the most significant part of the bulletin, which is the future liability to pay benefits deductions and how that impacts self-managed superannuation funds. The flow on from that is that we may, in some circumstances, be required to create an untaxed element. So what we want to do is address how the untaxed element is calculated and when it's going to apply. So we'll run through that as part of the presentation, and we'll finish off with modifying our disability benefit. So when we are taking a payment subject to permanent incapacity, what that actually means from a taxation point of view from a client scenario. So what we know is that self-managed superannuation funds are still a very powerful retirement income and estate planning vehicle. So even though we had some significant changes occur as part of the superannuation reform that happened from 1 July 2017, and specifically the introduction of the transfer balance cap, self-managed super funds still provide us with a significant opportunity with regards to planning not only for retirement but also disability or the unfortunate situation that will apply when a member passes away. So one of the things that we always have to contemplate is who's going to receive our benefits, because ultimately we want to receive our benefits as a member, but in the event of death then we need to pay those benefits elsewhere. So we need to contemplate that as part of our ongoing fund strategy. How do we pay that? Do we pay it as a lump sum? Can we pay a pension? So again, if we're talking about disability benefits, will we be paying a lump sum to ourselves? Will we pay ourselves an income stream? If it is a death benefit, how will the payment be made? Do we want to take it out of the system or leave it in and pay it as a pension? And again, a lot of that's going to be directed now by the transfer balance caps. Also, can we recontribute money to the fund? So these are parts of the questions that we have to ask ourselves, and then how can insurance in these situations help out the fund scenario? Now, one of the things that we often talk about is the tax liability of the recipient. So who's receiving the benefit and how much tax are they actually having to pay? But one of the other areas that we need to contemplate is what is the fund tax liability and what can we do to alleviate the liability of the superannuation fund from a taxation point of view. And so these insurance-based deductions go some way towards helping that situation out. So ultimately what we're doing is, in contemplation of things like the transfer balance cap, it's how does insurance help clients in certain situations. You know, particularly when we've got contribution caps and other things, insurance certainly still has a fairly large part to play in the super environment. So what we need to know, or what we need to understand, is there are certain deductions that are available if we hold insurance inside a self-managed fund. Now, the capacity to claim any sort of deductions on those insurance-based premiums is really going to come down to the individual needs of the superannuation fund. But most superannuation funds tend to do their tax planning on an annual basis, and so ultimately what you have is this section 295(465), which gives us our deduction for our insurance premiums. And as the most commonly used deduction, generally what happens is our fund will pay the premiums for the insurance policies over the life of the members, and then they will claim a tax deduction to the value of those premiums. And in effect, what you're doing is reducing the tax liability on the income of the fund, largely the contributions that are being used to fund those premiums for each of the individual members. So that's our most common style deduction, the Section 295(465) of the Income Tax Act 1997. But then beyond that, we have another deduction available, Section 295(470), which is a deduction for a future liability to pay benefit. Now, this is a deduction based on the actual payment itself, so the insurance-based payment or the payment linked to an insurance policy that is made when a particular life event occurs, and that might be a disability payment or it might be a death benefit, potentially a terminal illness, and I'll touch on those in a moment. But the way that this deduction works is it's instead of or post our capacity to claim the premium-based deduction, and it is providing a much larger tax outcome in many circumstances surrounding self-managed super funds. One of the catches is that it's only available based on the way the calculation works if the member is under 65. Now, one of the key issues about insurance-based deductions, whether you're claiming on the premium or whether you're claiming on the future liability to pay a benefit, is that you may be required to calculate an untaxed element, and that's often going to be driven by who the recipient is. So if we're paying a death benefit out to a tax dependent, we've got no tax to pay on that benefit, so we don't need to worry about our untaxed element. But if we are paying to a non-tax dependent, then we do have to consider it. And it's important to understand that that applies regardless of which deduction we're claiming. And so it is one of the considerations when we have insurance in the fund is what's the purpose of that insurance? Who is the end beneficiary going to be? And will that create a potential tax liability that they might be unaware of, that we need to give them information for in advance? So when we're looking at claiming the deduction, if we take it right back to the premium-based deduction, the legislation gives us the capacity to claim the deduction under Section 295(465) and then subsequently 295(470, as long as the benefit that is being paid is a superannuation death benefit, a benefit payable because of a terminal medical condition, a superannuation disability benefit, or a superannuation income stream payable due to temporary disability. So again, what we look at from a super fund point of view, the most common type of insurance that our members have is death and TPD. Now, a TPD policy needs to meet certain criteria with its definition to be eligible for a tax deduction. Similarly, it needs to meet certain conditions for it to then be paid out of the superannuation system, and that's where we come into our definition of permanent incapacity that we'll go through shortly. But when we're looking at paying death benefits and terminal medical condition payments, but specifically death and TPD, we do have the option of paying out pensions in certain circumstances and lump sums. And so what we need to identify is what or how are we going to pay the benefit out, and subject to that decision, is there any tax benefit in claiming this deduction potentially under the 295(470? Because if we're going and claiming our premium-based deduction under 295(465 and then the member passes away and all proceeds are going to be used to pay a reversionary pension to the member's spouse, well, that fund's going to be 100% in receipt of exempt current pension income, and so we don't necessarily need any tax deduction. But if you've got members that are in accumulation, then that tax deduction might be of some value to offset tax on other income within the fund. So it's one thing that we need to give consideration to. So when we're looking at claiming the deductions, we need to be paying death benefits, terminal illness, disability benefits, and temporary incapacity. We're not really going to focus on the temporary incapacity as part of this presentation because for the point of the 295,470 deduction, it's not going to create any real significant deduction like the death and total and permanent disablement deductions can create. So we'll effectively consider that if you've got income protection inside your super fund, that you're just going to continue to claim the premium-based deductions. What we do need to understand is superannuation disability benefits work and how they differ to permanent incapacity. And ultimately what we're really talking about here is a difference in the definition between the Tax Act and the SIS Act from a superannuation compliance point of view. So one definition determines whether a benefit is entitled to receive tax concessions, and the other definition determines whether or not the money can be accessed and taken out under a condition of release. So from our disability superannuation benefit, it's a benefit that's payable to an individual because he or she suffers from ill health, whether it's physical or mental, and two legally qualified medical practitioners have certified that because of the ill health, it's unlikely that the individual can ever be gainfully employed in a capacity for which he or she is reasonably qualified because of education, experience, or training. Now, when we look at that definition next to the definition of permanent incapacity, the key to permanent incapacity, it says a trustee is reasonably satisfied that the member's ill health makes it unlikely member will engage in gainful employment for which they're reasonably qualified by education, training, or experience. So under permanent incapacity, we're only needing the trustee to sign off on the illness of the members, not two medical practitioners. But that is a fairly risk-averse type definition when you're looking at self-managed super funds, because you're effectively entrusting the member to make a statement about their own disability to determine whether they can access the benefits. But ultimately, tax is the overriding factor here, and to be able to receive the benefit as a disability superannuation lump sum or a disability superannuation pension, you need to meet the tax definition, and so you need to get those two certified or two qualified medical practitioners to sign off on the condition. So even though there is a slight difference between the two definitions, ultimately from an SMSF point of view, you're wanting to get those two medical certificates to ensure that the fund A can pay out the benefits with the tax concessions attached, right? And in this instance to be able to claim the necessary tax deductions, and B, that it's going to flow through the audit of the fund without raising any questions. So let's have a look at this future liability to pay benefits and how it actually works with regards to our self-managed super fund and consideration of claiming it. So effectively, we have a situation where the fund's got the entitlement to a deduction because the member dies or becomes disabled prior to their last retirement date. So that's the trigger of age 65, prior to their last retirement date. And the fund pays a benefit as a consequence of the termination of employment. Now that's a pretty critical statement in this whole situation, because what that's saying is, one, you must be an employee, or as the legislation provides for, you can also be self-employed, but the benefit payment you are receiving has got to be because of the consequence of you ceasing work due to your disablement. Obviously death is a little bit of a different situation, and the death benefit is being paid out because the member has died, and then the payment is paid out in effect as soon as practical after that point in time. But from a disability benefit, what you've got to be mindful of is that disability can obviously last for a lifetime. So you've got temporary and then permanent incapacity, which means that you can continually take benefits out of the superannuation system under the condition of release of permanent incapacity. But to avail yourself to this particular tax deduction, it's really only going to be that first payment that is made, which is the result of you terminating work due to the disability, the insurance proceeds coming into the fund and you paying out a benefit either as a lump sum or a pension. It's only that payment, generally in that first year, that's going to be able to access this tax deduction. So you do need to be mindful about that consequence of termination of employment. The fund has to make an election prior to lodging its tax return in the year of the payment, right? And that election is made in accordance with section 295, 465, paragraph 4, that you're no longer claiming, or you're not going to claim a deduction for the premium in that year. So this is a little bit of a scenario where it means prior to the year of the event and payment, you can actually claim a deduction on the premiums, but in the year that the payment is made, the fund has to elect not to claim on the premium, but rather to claim on the benefit payment. And then once you've done that, it's irrevocable and you can't go back and claim premium-based deductions without getting the approval of the Commissioner of Tax. But from an SMSF point of view, when we start to look at these deductions, the likelihood of needing to go back and claiming on the insurance-based premiums is fairly unlikely. And the key to these deductions is any excess, because you claim it all in the first year, creates a tax loss, and you can carry that tax loss forward. Which of course is why I made the comment about if the fund is 100% in pension, it not necessarily being that beneficial, because in an exempt current pension income environment, the tax loss gets wiped out before the ECPI applies, which is kind of pointless if 100% of the fund was going to be entitled to an exempt current pension income deduction in the first instance. So ultimately is far more beneficial where you've got accumulation members in the fund. So the way that we calculate our deduction is we take our benefit amount, which is the entire amount of the lump sum. So if we've got insurance proceeds coming in and we're adding them to our superannuation proceeds, our existing proceeds, to have our final benefit amount, that's what we're going to calculate the deduction on. We multiply that by our future service days, which is in effect either our date of disablement or date of death up until our 65th birthday. So that creates our future service period over our total service days, which is the start of our eligible service period plus our days from disablement or death up until our 65th birthday. So we've got that total period there. So these are our important numbers that we need to be able to do the calculation. So if we have a little bit of a look at a case study, and the case study, what we've identified is that we've got Bill, and Bill is 45, and unfortunately for Bill, Bill passed away on his 45th birthday. Bill is married and has one child, Ben, who is 19 years of age. Now Ben is actually employed and is not financially dependent on his father, so we'll come back and look at Ben in a short while. But ultimately what we've got here is a situation where in the instance of Bill's death, he can pay his benefit to his spouse as a superannuation death benefit. We've got a service period where we started working in September 2001. He is an employee, so that's obviously critical in our situation for the inconsequence of termination of employment. So clearly Bill's work has ceased because he's died, and clearly then the benefit is going to be linked to that if we get it in and pay the amount out to his spouse. Target retirement age is 65. That gives us our future service period there. So what we have is we have Bill with his superannuation of $300,000, which includes $200,000 tax-free. We then have our insurance-based amount of $200,000, which is going to come into the fund, giving Bill a total of $500,000. So when we do our calculation for the future liability, we've got $500,000, we're multiplying it by 20 years, which is our future service period, and then dividing it by 38 years. Now, when we do the calculation for our clients, we actually have to do it based on the actual number of days. So this is just for illustrative purposes that we're showing you the calculation with the number of years involved here, and because I've conveniently made Bill die on his birthday. So what we would look at in a normal circumstances is how many days have we actually done, and I'll show you an example when I go through disability a bit later that uses the number of days calculation. But as we can see, when we apply that formula to our $500,000 benefit, we actually get a tax deduction of $263,158. And so in real simple terms, if somebody dies halfway through their working life, then they're effectively going to create a tax deduction for half the value of the total benefit payment. And that's, I guess, the simple way that I like to think of this future liability deduction. Now, that amount can be used to offset capital gains tax, tax on contributions, other income inside the superannuation fund. So in this instance, if Bill had, let's say, $35,000 worth of assessable income in the fund, then he would offset that $35,000 with the deduction and create a carried forward tax loss of about $228,000. So it's a pretty significant benefit that the superannuation fund is receiving from the use of that tax deduction. But as I said before, when you have these insurance-based deductions, whether it's a premium one or the future liability benefit deduction, you do have to consider whether or not to calculate an untaxed element. So we need to know how that applies and how to actually do the calculation. Now, the untaxed element itself is only calculated if we're paying a death benefit to a non-tax dependent where the fund has claimed or is likely to claim or intending to claim an insurance-based deduction, either under the premium-based deduction, 295,465, or under the future liability deduction, 295,470. Now, this raises a lot of questions because people say, well, we haven't claimed for a couple of years for whatever purposes, but we have claimed in the past. Does that mean we're still required to calculate the untaxed element? The answer is absolutely. So if the benefit has incorporated those insurance proceeds and a premium has been claimed at some point in time where a deduction has been claimed, then you need to calculate the untaxed element. So the way you do that is you go about the process of calculating the taxable and tax-free components of the benefit payment as you would do in any set of circumstances with regards to a lump sum benefit. So you establish what your proportioning is, which is pretty simple if you're doing a final payout or a full payout, because then you know exactly what your tax-free amount's going to be. Once you've done that, you then need to work out the element that is taxed. So this is the amount that is subject to our 15% liability plus Medicare if it's being paid out directly. So the amount of element taxed in the fund is calculated by applying the formula, which is the lump sum times by the service days over the future service days, or over the total service days. So the what you've served plus what you've got up until retirement. So once we do that calculation, we reduce it by any tax-free component we have in the fund, and that results in our element that is taxed. And then to work out our element that's untaxed, we take our taxable component and we subtract the element taxed, and the balance will be untaxed and taxed at 30% plus Medicare. Rather than look at words, let's look at some numbers and see how this is going to pan out. So again, let's go back to look at Bill and Bill's situation, but now Bill is paying the benefit to Ben. Right? So we know Ben is 19 years old, we know Ben is not a tax dependent, right? So therefore we have to pay the untaxed element. And this could be applied because Bill and his wife could have separated. Bill could have just made a decision because of the way that their assets sit that he wanted to pay the benefit to Ben. That's going to be unlikely if the spouse is still around, but it may happen in certain circumstances, and obviously is one of the decisions that's going to be considered with regards to estate planning purposes. So we're paying Ben, we've got our $300,000 right, which includes our 200 tax-free, as I said before, and our insurance proceeds of 200. So because of the 200,000 tax-free, this gives us a taxable component of $300,000. So to work out our element taxed in the fund, we take our 500,000 being the full benefit, we multiply it by the 18 years, which is the service period. We would divide that by the 38 years, which is our total service period. So the 18 years is what we've already served. The 38 incorporates the future service period element. And that gives us 236,842. We then subtract the tax-free component of 200,000, leaving us 36,842, which is our element taxed. We tax that at 17%, but we actually tax it at 15% plus Medicare. It goes out directly, but in this instance, I've just put the 17 there, which gives us a tax amount of 6,263. We then have to work out our untaxed element, which is our taxable component, the $300,000, less the element that's taxed in the fund, the 36, gives us 263,000, which is taxed at 32%, so 30% plus Medicare, or ultimately $84,000. So in effect, we're paying Ben a $500,000 benefit. We are subtracting about $90,000 tax from that, so he'll get roughly $410,000. But what he will also get is that full future liability to pay benefit deduction, and that amount's going to be the same as was calculated before, and that can be used to offset the tax on contributions. So Ben in this instance is going to have $268,000 or thereabouts to be able to offset the future contributions that he makes into a superannuation fund. And if you took a really simple example and said that every year Ben contributed $25,000 to super, so therefore that $25,000 is the assessable income, well that amount of deduction is going to see him offset the tax on that for roughly the next 10 years. But that's give or take, obviously a little bit subject to, and definitely subject to other assessable income in the fund. But as I said before, when we look at this as an overall deduction, not only is it applicable to death, it's also applicable to disability. And so what we need to understand is that when we have a superannuation disability benefit, and it meets our definition of the disability benefit with the 2 medical practitioners, then we have a capacity to modify our tax-free calculation for the benefit. And this is the only time we actually get to muck around with the taxable and tax-free components of superannuation, is when we modify the tax-free amount to do with disability. Now that occurs if we pay a lump sum. It doesn't apply if we pay a pension. In pension we get a 15% rebate to offset the tax, because we pay our marginal tax on the pension and then we get our 15% rebate. But we do get to modify the amount if it is a lump sum. And the modification looks not too dissimilar to our future liability calculation. So again, it's based on our days to retirement over our service days plus days to retirement. And what that actually looks like is an amendment to the existing tax-free calculation. So the best way to show that, as with Bill's case, is to have a look at Kate's situation and identify what the calculation is going to be. So in Kate's circumstances, she was born in 1971. She ceased work in September 2018 due to disability. Her service period started in 1996, and again her target retirement age is 65. Her super proceeds is $400,000, which is $200,000 sitting in super and $200,000 of insurance. And in amongst that is $100,000 of tax-free benefits. So that date of cessation is when she ceased work due to disability. We have a look at what we do first for Kate's situation. Well, the first thing we do is we do our normal proportioning of benefits. Now, of course, this is far more relevant if you're taking a smaller amount out, but if you're taking the full benefit out, then working out what your existing tax-free amount is going to be relatively simple. But for calculation purposes here, it's $100,000, or from a percentage point of view, it's 25% of the total benefit. We then apply our modified calculation to our benefit amount, $400,000. So we times that by our days to retirement over that total service period. You can see here I've used the number of days in the calculation. So we've got a modified tax-free amount of $178,276. We then add that to our existing tax-free amount of $100,000, meaning we've got a total tax-free amount in this benefit payment 2K of $278,276, which means we've got a taxed amount, a taxable component of $121,724. Now, Kate's taking that out as a lump sum. 20% is what you pay on a disability superannuation or on a lump sum if you pay it before you hit preservation age. So we're paying 20% plus our 2% Medicare levy. Overall, the tax payable is going to be $26,780. But if, for example, Kate took that money out because the condition of release of permanent capacity said she could, but she didn't get the medical sign-off, then that would be a permanent capacity benefit. It would be not subject to the modification, and she would have paid $66,000 in tax. So it's a fairly significant change when we actually implement the right conditions and get the right sign off by the right people, in this instance the medical practitioners. But again, if we look at it, Kate can also claim the future liability benefit deduction, and on the $400,000 it's going to give us a tax deduction of $178,000 for the fund. So what we look at there is, if we're paying a disability benefit out, we could pay a pension with that $400,000, and if we pay a pension with that $400,000, it's going to ensure that the fund is entitled to an exempt current pension income deduction. It means we're going to be taxed on our marginal tax rate on any withdrawal we actually do. But what we can do, and so over time, depending on how young the person is, that tax might add up to a higher amount than what we pay on the lump sum, and that's part of the calculation that you would need to perform. But in this instance, we could take a lump sum, we can then get the future liability deduction, use that $178,000, and then use that to offset the tax if Kate potentially chose to recontribute. Perhaps Kate's got a spouse and the spouse is contributing to the super fund, and so we can offset the tax with that amount. Perhaps there might be children that are coming into the fund who are going to contribute, and we can offset their tax. So there's lots of reasons to consider the use of that future liability benefit. But of course, a modified disability amount is there because we are actually taking the benefit out as a disability superannuation payment. And so what that leads us to in conclusion is that we've now got a situation, due to the changes from 2017, where it's very specific when you can and cannot pay a pension, and it's going to be linked to how much money you have in super. Now, how much money you have in super should never be necessarily the predicator for what you're actually going to have from an insurance point of view, because your purpose of insurance is not necessarily to top up your super. Your purpose for insurance is to consider other liabilities and things that you might have on the outside. And so it's supplementary in a way, but if you hold that insurance via super, then you're going to get the associated tax deductions. But of course, now we've got our $1.6 million transfer balance cap, which limits how much we can put in pension, which then limits how much we can retain in the super system after a life event actually occurs to us. But critical in the super reform is the capacity now to roll over death benefit pensions. So previously you could only roll them over if you were immediately going to cash them out of the system. And so what this actually means is if you've got a surviving spouse and you've got contributing children in a super environment, what you can actually do under this future liability deduction is you can actually get the proceeds of the death benefit, and you can pay a death benefit pension to a spouse, and the children might be in that fund. You can then calculate the future liability deduction, leave that deduction in the super fund, roll the pension and its associated exempt current pension income to another fund, and utilise that deduction to offset the tax and the contribution tax for the children members of the super fund. So, you know, there's lots of things that you can consider, but of course also the spouse might be of an age where they're still accumulating, and so you could in effect move their pension elsewhere and use the deduction to offset the tax on that accumulation proceeds. But as a final point, it's important to highlight, I think, the concept of terminal illness and what that means in the super environment, because if you have clients who are unfortunate enough to be diagnosed with a terminal illness, and that illness is likely to result in their death in the next 2 years, then we know that they can take their benefit out of super as non-assessable, non-exempt income. So we don't change the components. What we do is we just say you can pull it out and you're not going to declare it as income. But if they do that, we can calculate this future liability deduction. And so that's really powerful in that not only are you getting the benefit payment tax-free, you're then creating a tax benefit for the superannuation fund. And so if you go back and look at Bill's situation with Ben, if we assume that instead of just dying suddenly, if we assume that Bill was to pass away from a terminal illness and he received that diagnosis inside that 2-year time frame, well, Bill could have taken his $500,000 out as a terminal illness benefit. The fund could have got the full tax deduction under the future liability to pay benefits. Ben could then contribute to the superannuation fund and have his tax offset by that deduction, but we've avoided the $90,000 tax created by the untaxed element on a death benefit. Now, of course, circumstances are always going to dictate whether or not you can utilise that, but if there's a capacity to take money out under terminal illness rather than to leave it in and have it eventually paid out as a death benefit, and clearly adult children are one of those triggers for that scenario occurring, then ultimately it's worth looking at the numbers to see what sort of tax or potential tax benefit can occur. Of course, a part of all of this is that self-managed super funds are not obliged to have insurance. And of course, the last time that any realistic statistics were taken, only about 13% of self-managed funds actually held insurance. But given that now it's a consideration requirement of the investment strategy, you would expect that that number has to some extent increased. And if that's the case, then the opportunity for people to use this deduction will also increase. And of course, the other part of it is that it's only applicable to those people under the age of 65. So it's certainly not something that we need to consider when our clients have hit pension age, have ceased working, are in receipt of a pension, and they pass away or become disabled. So look, thank you very much for listening in. As I said, this bulletin is also available in written format, and we look forward to presenting our future bulletins also in an online environment. Thanks very much.